I was just saying I'm just coming off my cold and I'm getting better, so hopefully I don't cough as much as what I did last week. But hello, everybody, and welcome to this week's edition of Selfwealth Live, the technical analysis edition, Selfwealth by Scythe Live. I've still got to get used to saying this, as we know, obviously we're acquired by a company called Scythe now. But you, Jason, you haven't changed. How are you going over there in Motion Trader world?
Hey, Rog, I'm good. Everything good over here. And looking at some charts this morning, some movement in the market. So I've got plenty to talk about. I'm sure there'll be a few interesting questions and stocks from our viewers to have a look at as well.
For sure. So basically, for those who haven't been before, welcome everyone. Welcome the long timers. Welcome the newbies. We love having you here. We love being able to field your questions and hopefully answer as many as we can, along with your tickers, obviously. Just if you didn't know, the way we run this show is we go through three major markets that we offer at Selfwealth by Scythe, and that is the Australian market, the US market, and the Hong Kong market. So from an index perspective, we have a look at how that's tracking overall. We've got a couple of general questions today, one around software around tax time, as well as ETFs and how we treat them. So we'll get onto those around the middle of the show. And then obviously the major part of the show is how it's become, is us having a look at the tickers that you want us to look at, right? So the tickers, feel free to put a couple in there. We'll get to as many as we can. All right. That's the aim of the game in the long format that we run here. But hopefully we can provide you some insights in the way we think from a technical analysis perspective as well. So going to be a great show, Jace. There's been some positive, despite all the bad stuff that's happening in the world. For the stock markets, there has been a positive move overnight. So without further ado, before we do get into that, let's get into that disclaimer, please. Thank you.
So, of course, everything today, general commentary only. We don't take anyone's personal situation into account. And I just quickly put up the disclaimer that we do each week, and that just goes through that, all the general commentary and also licensing. So I'm not part of Selfwealth Scythe. I'm Motion Trader. My details are at the top, and then beneath there you'll see the Selfwealth disclaimer as well.
Fantastic. Thanks, Jace. All right. So as I said, there was overnight a bit of a push up. Let's have a look at that Australian market, if that's okay, please.
Yeah. So we'll start off with the ASX 200. And so we've seen it during the last couple of weeks. We've seen that steady.
Share the screen. I don't think we've got your charts up.
Oh, okay. Hang on. Let's try that again.
There we go.
Excellent. Thanks for that heads up, Rog.
Right.
It's So here we go. Here's the ASX 200. So for the last couple of weeks, we've had this steady pullback. And what's notable about this pullback is that it's actually the longest pullback since the April low. So it's not the deepest pullback. That was shortly after the April low, where markets rallied back and they came back quickly and then continued on. But it is so it's not the largest, but it is the longest time between new highs. So you can see all these previous times the market rallied, pulled back, made a new high, rally, pull back, high, and you can see that sequence continue. And now we've got this longer pullback, couple of weeks. So is this a long-awaited pullback back towards the moving averages? And it certainly has. Looking at yesterday's low, it has come back close to the 50-day moving average. And regular viewers will know this is something we've been discussing for several weeks, ever since prices started to get stretched above the moving averages. So I'm using, of course, the 50-day and the 100-day moving averages. And the reason I've held that view is because prices have historically been stretched when we look at like what they've done in previous times. Just quickly, I'll just show you what I mean by that. Regular viewers will know this well, I think. Let me just compress this so we can get a bit more data. And so when the ASX 200, so this indicator measures how far above or below the 50-day moving average the market is. So when the market gets to around 4% above its 50-day moving average, you can see from these past times, that's where it typically, there can be overshoots, of course, but it generally seems to pull the market up when it gets to about 4% above the moving average, which has currently been, and now we are eventually getting that pullback to the moving averages. So is this pullback likely to continue? I think the prospects of a longer consolidation I think they're very much alive, and like this has been like, we shouldn't lose sight that this has been a large and historic rally and an uninterrupted rally off the April low. And I think what would be unusual would be for the rally just to continue onwards and upwards without being checked. And remember, pullbacks towards the moving averages are a normal part of a rising trend, and they simply provide a counterbalance to periods of strength, and then often that produces a new platform from which we get consolidations, and that provides a new platform for higher levels. That's often how this works. So having a look at the equal weights, this is the ASX 200 index. Now let's look, and that's of course like the largest stock will have the most influence. Now let's look at it on an equal weight basis, where the largest stock and the smallest stock have the same influence. And this is interesting to have a quick look at this. I think it's another reason to give weight to the prospect for maybe some more consolidation in the next week or two. Just look where the equal weight appears to be stalling from. You can see the market's rallied up into this blue horizontal line, and it's pulled back over the last week. So just look at this blue horizontal in a little bit more detail. So it contains the high from February, a couple of highs from late last year, and if we compress it, it goes over to the high from December 2021. So some notable technical areas which the market has just reached. We can see so we've had this pullback, and this, you often get this, markets reach these key previous peaks, and we do sometimes see that consolidation. So maybe that's another reason why we could get a few weeks of sideways price action, or even a little bit lower towards the moving averages during this period. We're also seeing something similar play out in the small ordinaries and in the emerging companies index. So there is some broad-based consolidation happening at the moment. Just coming back to the ASX 200, I think the overall structure, I think that remains positive. We've got these rising moving averages, prices now well established above the moving averages, been above the 50-day moving average since April, so for a couple of months now. And every bullish phase is associated with that condition, with price being above rising moving average. So I think that's overall a good backdrop. From that perspective, I'm happy to stay long the ASX 200 index and individual stocks. As we've discussed over the last couple of months, it's really been a process. This is what we've discussed: this process of gradually getting back into the market over the last, say, 6 weeks or so now, and by doing that, it avoids a situation where you sit back on the side, you watch the market rally, and then you start thinking you're missing out and piling in near previous highs. So then you end up with potentially a top heavy portfolio near the highs, and then markets pull back and people get worried. So gradually building a position that makes these pullbacks a whole lot easier, I feel, to sit with. So I'm happy to hold with what's working, use those wide trailing stops we talk about all the time, and try and see off any further weakness or sideways consolidation. But unless an opportunity particularly stands out, I don't think there's a need to just keep rushing into the market. And I certainly don't want to chase stocks that run hard, given there's a possibility of some more consolidation. I'd like to see how this pullback develops. And so far, we're seeing signs of buying the dip with that nice rally off the low from yesterday. And if we continue to see that support developing on the pullback, I think that could lay the framework for higher levels in maybe in the weeks or months to come.
Mm-hmm. All right, fantastic. It's positive at the moment for the ASX. What about the US markets? Let's have a look.
Yeah, so the US markets have had another resilient week in the face of ongoing uncertainty. And if this so you just think, Rog, if this was a bearish environment and people were on edge, the sort of news flow we've been seeing would often be the fuel to send prices lower. But that's not how this has been playing out. It's the market which continues to hold above its moving averages. So as it stands, the dips have been bought the whole way up. Yes, look, from each of these pullbacks, the dips are quickly bought, and the price and the path of least resistance is to the upside. So it's really been a case of buying the dip, not selling the rally. But while the S&P 500 and the Nasdaq, they're only about 2.5% below their all-time highs. The broader market isn't quite keeping pace at the moment. So it's interesting when you look at benchmarks like the Dow and or also the S&P 500 on an equal weight basis, and they're about 6.5% below their all-time highs. I'll show you what I mean. So here's the Dow. There's the all-time high. Prices are about 6.5% below. The Dow's not exactly a broad measure of the market. It's only 30 stocks, but nonetheless, it's still an important index to keep an eye on. And you just look at the moving averages, the 50 and the 100 day. They haven't quite crossed yet. They're getting pretty close. But price has been consolidating above the moving averages, and they're continuing to turn higher. But nonetheless, there is a lag to what we're seeing in the S&P 500, and we're seeing something similar in the equal weight. So this is the S&P 500 on an equal weight basis. So when we look at this one, unlike the Dow, the moving averages have already crossed. But again, it's been a month of consolidation. You see, price is just moving sideways along the moving averages. So consolidation above moving averages is generally a positive. So I don't think this is a concern, but I do think it's just that pattern of consolidation which has the potential to run for a little bit longer, perhaps. Coming back to the S&P 500, I'm continuing to play this from the long side. I think the overall price structure is positive. We've got price above these rising moving averages. So rising moving averages, price is above the averages. So that's a positive from the way I look at these things. And the price action suggests that the interest is in buying the pullbacks, not selling the rally. So again, another tick. I actually added some exposure to the market this morning. It wasn't in the S&P 500. I did that. I've got some S&P 500 a few weeks ago at lower levels. What I did, I'll show you what I did this morning. It's an ASX listed ETF which focuses on global small caps. Predominantly they're in the US and Europe, but the US is the largest component. Let me just quickly show you what it is. QSML is a ticker code. It's a Van Eck ETF. So this was interesting. It looks like it's lifting off its moving averages. So you can see for the last month it's been trading sideways along the moving averages, much like the S&P 500 equal weight. Just seems to be lifting off those averages now. I'm happy to go with this momentum, see where it goes. As we were talking about with the markets generally, path of least resistance seems to be in the upside, and as always, managing risk with those wide trailing stops. So I think that's the play. It's staying along the market. It's looking for opportunities where they come along, but also be aware maybe we do get some more consolidation, but that overall structure is still positive.
Yeah, I'm glad you brought that up, actually, Jason, because I've got a question off the back of that, and we're going to get onto that because there's a few ETF questions in there, and we're going to talk about the difference between ETFs and single stocks, obviously. So, and from what I can see, there's something that hasn't happened here that you would normally follow, right? So, but let's get on to our Hong Kong market.
So over to Hong Kong. And so last week we talked about there was a bit of a pullback developing near the all-time highs, and that continued through the week back to the 50-day moving average. And now we're seeing this nice rally develop off the 50-day moving average. And of course, that's positive because it shows there's interest in buying the dip. Overall, I think the price structure here looks encouraging. I think it looks positive. In terms of how to play this one for now, I'd probably rather just watch this one because prices are close to that March high after a largely uninterrupted rally. So maybe there's scope for a bit more consolidation. But if I had exposure here, I'd be very happy in maintaining that exposure. The one that I think does look particularly interesting, it's the Chinese market, which we don't hear about that often because it's been off people's radar for so long. What's happening here? Like, look at this. Prices have been trading along their moving averages for the last few weeks. And so the first encouraging thing is that prices have been holding their gains. So we've had this good rally off the April low, and prices have held onto those gains over the last the last month. So that's something the Chinese market hasn't previously done a good job at doing since for months now, where we get strong rallies and then we get strong pullbacks, rally, pullback, and that's an ongoing sequence. This time we have a rally and holding along the moving averages. So that's a shift in how this has been behaving to date. And I think the key now is for a breakout. So we're seeing prices rally off the moving averages today. What I'm watching now, I'm watching the high from May and from March. So a breakthrough this these previous highs, which prices are now starting to challenge. I think that would be something which would be worth considering buying. I think this is there's certainly potential with the Chinese market. I like that it's off most people's radar. Like, is this a large basing structure over a couple of years, which is now starting to round higher? It'd be it could be the surprise market most people aren't watching. So hasn't broken higher yet, but we do have some encouraging price action to watch. ASX listed ETFs pretty much mirror this. It's the China A50, so you can find an ASX listed ETF that does this sort of thing. And I think we can manage risk quite effectively just with, like, if it breaks higher, and if someone were to buy a position, and if prices then came back and started to get back down towards this blue horizontal area again, well, it could be closed out for not too much of a loss, but upside could be quite good if it does run. So one to keep a close eye on.
Okay, fantastic. All right, let's get on to some general questions. We'll start off with the easy one, Jace, as we're less than a week away from the end of the financial year, and I have a client who would like to know, what software do you use to manage all your ins and outs of stock, shares, and whatnot?
Look, there's plenty of good software out there. I use one called Navexa, and ShareSite is another one which I think is quite similar. And I think what the great benefit of these portfolio tracking software is that they make the whole thing a whole lot simpler. They you can get your tax reports from it at the end of the year. They automatically record dividends, which I think is a big plus. With previous software, I'd get the dividend would be sent out by the company, then I had to manually input it. But a lot of the more recent portfolio tracking software will do that for you. So that's a big help. And so look, it makes it easier. Like in the old days, I used to use an Excel spreadsheet and record everything manually, and it's just such a painful way to do it. I'd generally suggest anyone who's running a portfolio of more than a handful of stocks consider portfolio tracking software. It's inexpensive. It's going to be relative to everyone, I think, but I think it's only like you look. I think we're talking a few $100s a year. You got to check the pricing for yourself, but it's not. I don't think it's expensive stuff to get. If you got the capital to be investing in shares, you probably got enough money to get some of this software to make your reporting a little bit easier.
Yeah, I have a lot of clients that use the both actually. Main one that I hear about is ShareSite, but Navexa I know is another one out there, which is quite popular. And the beauty of it is that we, if you're not aware how it works, is basically the contract notes that get sent to you. They would be sent to the softwares, and they're the ones that they record everything off the contract notes effectively. So you would set that up in the back end with Selfwealth. All right, so most of these shared trading portfolios work that way. So it's quite easy to sort of set up and see your buys and sells. And I think they must receive dividend information from directly from the information providers out there, right? So quite smart in being able to do that. And if you want to save yourself some time or the account some time, who knows? Might want to check that with your accountant as well. It could also be tax deductible. So maybe check that with your accountant. Next question here is around ETFs, Jace. So, and you brought up the ETF before, right? But when we're looking at ETFs, should they be treated differently from individual stocks, since both have charts and moving averages? So we can look at them a chart, but obviously the way we look at them is slightly different. Wouldn't ETFs show the same patterns? What would you consider the difference between ETFs and individual stocks?
Yeah. So the pattern wise, yeah, I agree. I'm looking for the same structures. Like when I look at the ASX 200, I'm talking about the moving averages. I'm talking about price above moving averages. I'm going to talk the same way about stocks. You can see a consolidation, sideways consolidation along the moving averages. We see the same pattern in individual stocks, and of course, because the index is made up of individual stocks, so it's going to share that same. Going to have that same commonality with the individual stocks in terms of their price action. I think one of the key differences is, like, I can hold an ETF long term. I can have it in a super fund or whatever, and just not be overly bothered by it. It almost is. You could almost take a set and forget. I think set and forget sort of stance towards an ETF, like an ASX 200 or an S&P 500 ETF, because unless the world wraps up, they're not going to zero, because they're a collection of like stocks which is reweighted periodically, and so the index will continue on. And we've got this. You look at a chart of the Dow from 1900, or the S&P 500 from 1950, or wherever it may be, the ASX 200 going, or the All Ordinaries going back as far as it can go, and you can see, look, the index has gone up over time. But you can't pull up an individual stock chart from 1900 and see the same thing, because the names change and companies come and go, and companies can go to zero. And so that's why I wouldn't take a set and forget with an individual stock. So it's interesting. So Virgin Australia is relisting today, but shareholders in the previous round of Virgin Australia listings basically got wiped out. It went to zero. So individual stocks can go to zero, but the indexes, they don't. So I think that's a key distinction. So I'm always talking about trailing stops and understanding your exit strategy with the individual stocks. I think you can. I'd be more comfortable being longer term with an ETF than probably with an individual stock. And also, like a 20 or 25% trailing stop strategy mightn't be appropriate for an index, while it might be the right decision for an individual stock, because like individual stocks can come back 50, 60% sometimes, or more, 70%, but indexes usually don't do that. So you can have a little bit more leeway perhaps on how they're managed. So it depends what you're after. It depends how you want to do it. But I do look at the two groups. Price action wise, similar patterns, but the actual management of the position can be different.
Yeah. Okay. So let's have a look at that previous ETF you said you got exposure to this morning. This is where I'm going to question you. Sorry, Jason. But this did not follow your general rules around EMAs, from what I can see. So maybe you could talk us through this
Yeah,
technically,
so
or was it more of a fundamental play at the end?
no, not a fundamental play. It's a technical play, and so what I do with the motion trader, it's rules based. So when you have rules, it's clear cut. You program the algorithm to buy when prices are above rising in 50 and 100-day moving averages. So there's no discretion there. It's clear cut. But then I've got other portfolios that aren't systematic. So I've got my motion trader portfolio, which is just following the rules, and then I've got my more discretionary portfolios, which could include ETFs, where I'm doing things following a similar sort of process, but there's a bit more flex in in some of the decision making. So for me, this has gone from below the moving averages to above. Below to above, prices have moved sideways along the moving averages. The moving averages are close to crossing, and I can also see that prices just seem to be now breaking out of this compression pattern. So I'm happy to go with that now. I don't need to wait for these moving averages, which are close to crossing. I don't need to wait for them to actually cross, because I know the structure. And doesn't mean just because I know the structure, I've seen it before, doesn't mean it's going to work. But I know it does have a good history of working. So from a risk reward perspective, I think that it's an asymmetric setup. I can say that if I buy at current levels, if it doesn't work out, say it falls back below these previous lows, I might cut that for a 4% loss. But if this does take, well, then there's potentially a multiple of that. So that's how I'm doing that one. It's you can have, I think, within different portfolios, you can have different objectives or variations of style. Everything you do doesn't have to be the same way, but I think you need to have a clear idea in your head about what you're doing with your portfolios. You don't want one portfolio with a bit of this and a bit of that, because then that ends up as a bit of a mess potentially. But in separate portfolios, yeah, by all means, you can alter your approaches.
Okay, fantastic. Thanks for that, Jason. Good response around how the different sort of ETFs and single stocks. And I just like to add the idea of recapping at the end of the day with single stocks. Obviously, they can go to zero, so you do want to be tracking them a little bit more heavily, versus ETFs, which generally, depending on the asset that they're tracking, yes, they can go down as well, but not as aggressively, right? So, all right. So just
Well,
one.
of course, there's all sorts of ETFs. There's
Yeah.
like leverage ETFs.
Mm.
So, like, I wouldn't want to buy a triple leverage ETF and then shut my eyes and not think about it, because they can do some crazy things. But we talk just generally about your standard vanilla index ETF. It's you hold that medium to longer term. History says that there's that's generally an acceptable long term strategy. You can do that sort of thing. Whereas an individual stock, yes, lots of people will buy and hold forevermore, but some of those stocks they buy and hold forevermore may not end well. So that's the thing you've got to be aware of with individual stocks.
Yeah. And just going back onto that question around the Navexa, Jason, I know obviously our Selfwealth can have as a contract note service that sends to Navexa. That's how it links your trades to Navexa, same as ShareSite. But the question is basically, does Navexa link with your trading account, Jason? Is there another way that you know of? Or?
I don't know. I actually enter into the trades myself, but I get the dividends are recorded. There's probably I could probably do it a better way, but there's lots of functionality with these services, so it's just a matter of and they also offer free trials a lot of the time too. So go and have a look, take a free trial, just play around with a few stocks, and you've got to take a little bit of time to get a feel for understand how the software works, but yeah, I think most people would find a benefit by just investing a little bit of time and having a look around them.
All right, fantastic. All right, let's get on to some stocks now. Let's have a look, starting off with Alan's. G'day, Bob, and g'day, Alan. Let's have a look at PTN from Alan, please. Thanks.
Was that PTM?
N for Nelly.
Well, we're still range bound with this stock. You can see that's been the case for it's been for a while. Like probably since making a high in April last year, it's really been in a corrective phase, and then in more recent times, you can see it's really just moving within this band. It's probably not at the point where I'd buy it at the moment. I'd probably want to buy a breakout from the range. I like that it's had that strong rally off the lower end of the range. That's encouraging. The next step would be to see it like hold on to, like if it can hold on to the recent gains, that might set the stage for like a break higher. But we need to see whether that price action actually does materialize. Otherwise, it could just continue just to meander down towards the bottom end of the range again, as it's done several times previously. It's I think there's certainly potential with this stock. Like you look at is this the early stages of a turnaround? So it's had the first part of the turnaround. Now it's doing the lengthy consolidation. From there, maybe it can break higher again. Completely feasible, but for me to get in at this point, if I got in early, maybe I could still be sitting with it. But if I was looking to get in now, I'd probably want to buy a breakout to a new high. So one to watch.
Okay, all right. Let's have a look at an oil ETF from Bob, if that's okay. Any news on oil ETF? Trying to think what one would be, but maybe we can just look at oil in general.
Oil ETFs are. What is it? I can't think of an oil ETF.
Can we just look at oil in general, WTI or something?
So let's do that. We'll get the oil price. So it's like I'd just be leaving this alone at the moment. It's volatile and it's news driven. So we had the spike higher a couple of weeks ago, and then yesterday we've got like a quick move down. So it's really like where's the next trend come from? Like a break above the highs from earlier this week would probably be a sign that, okay, something really is developing and oil is heading higher. But this rapid unwind is also a sign that there's like, is there the underlying demand there to push it higher, other than the uncertainty going on around the Middle East at the moment. So I like to play setups where they're clear cut. We've got good levels to watch. We can calculate our risk is going to be relatively small compared to our upside. With such large swings, you've got to allow for more risk, I feel, and that means you need even more upside to make a worthwhile trade. Which is where it's like lining up from an asymmetric perspective. So I think it's just one to stand clear of and watch. It's too driven by the headlines at the moment.
Okay, fantastic. While we're looking at this, let's have a look at we've got James has pointed out Triple O is an oil ETF based ETF. So let's have a look at that one, see if it's done the same. Yeah, it has basically. So
if you bought on the first sign of trouble last week, you were looking good for a few days, and now you're back to maybe break even or maybe at a loss. And I just think does the volatility justify the position? As I say, I'd just be inclined to leave this one at the moment.
Okay, all right. Let's have a look at BCI. Irfan.
Yeah, I'd be happy to stay in this one. I'd probably also say I'd consider buying this one at the moment. It's like it looks to be starting to lift out of what could be like a 2 or 3 year base. It's gone from below the averages to above, below the averages to above, had a little bit of a sideways consolidation, broke higher again, starting to run. Let's just see. Look, if it were bought at current levels, maybe a 15 to 20% stop would be appropriate, and see whether it gathers pace. It's one of those ones which could double over a period of months. So I think it's got those asymmetric properties where the relative risk toward compared to the possible upside is favourable. It's also just starting to break above these previous high points. See these previous highs from from where is it? From October last year, and that looks January 24 thereabouts. Just starting to clear those. If I had this, I'd be happy holding it, and if I was interested in this stock, I'd consider buying it at current levels.
Okay. Next one is PME.
It's it's one of those ones. It was like a real boom stock. Ran into trouble through that volatility earlier in the year, but it's come straight back. Just like the equity indices as well. It's been consolidated, come back to the moving averages. Looks like it's rallying off the moving averages now. If I had it, I'd be happy holding it. Would I want to buy it at this point? It's it's come from, in the space of a couple of years, it's gone from where's that, $60 to $280. It's not to say it can't keep going higher, but it has been an extraordinary run. Look, no problem holding it if I had it. It probably could be bought at current levels too. I don't know that I'd be expecting the same sort of upside as what we've seen over the last couple of years. That would seem unlikely to continue. Anything can happen, but path of least resistance at this point does still appear to be up.
I'm just curious to see. I'm curious to know what's the most expensive stock on the ASX. But it'd be interesting to know, right? I think
CBA is up there. Like, it's the largest cap stock, but it's also got a share price over $100. It's not too many stocks have share prices over $100, but people also get caught up in what the share price is and go, oh, there's no point buying $100 stock because it's already so expensive. But it's relative to how many shares are on offer.
Yeah.
So $100 stock and there's only 1,000 shares on offer. It's a tiny company, so it's all relative. Don't get hung up by the share, by the headline of the share price as such. Focus on the price action. Look at the market cap of the stock. Maybe that's your guide to more of a guide, I think, than just looking at a number as such.
Yeah, fair enough. All right, let's have a look at Sydney's here. Let's have a look at two Hong Kong stocks. This is 388 to start off with.
Yeah, well, there's an upward trend in place here. I'd be happy staying with this one, and it's also like broken out of this. You can see this consolidation through here. Thereabouts. I haven't lined it up perfectly, but that you can see the consolidation. It's broken high from there. Like, it's one of those stocks, I guess, could be bought at current levels. Maybe there's some more consolidation, but it's going with the overall momentum. Exit point could be just back within the range if it doesn't all work out. But yeah, I'd be happy running this one and seeing where it goes.
Okay, the next one's 1572. That one there, yep.
Probably not so much this one, because it hasn't really broken high yet, and it's been prone to these spikes higher, but then they quickly come back, and it's doing the same thing again. We could argue that, okay, it's had a strong move up, and yes, it's had a large pullback, but it hasn't. It's not pulling back at the same speed. It's sort of like particularly over the last few weeks, it's been a slow and meandering type of pullback. So maybe that's a sign there's buying interest coming in to underpin it. But look, that's not enough for me to say, look, I want to take a position. I'd rather buy it if it starts to lift off its current levels and start showing some signs of regaining upward momentum. But it's been a pretty tough stock. Buying momentum hasn't worked on a number of occasions, so I'd probably be inclined to leave this one.
Okay, back on the ASX, NVI, please. N for Nelly, sorry.
NVI.
Yeah, NVI. It's not there. Nothing on the ASX.
Don't see anything on the ASX for NVI.
All right, let's move to the next one then. Let's move to DUG, please.
Yeah, this was a great motion trader stock. I had this one myself and rode this lovely uptrend, and this is why we have trailing stops and why you don't turn your back. Like the ocean, don't turn your back on the ocean, don't turn your back on individual stocks, because trends change. And so I got out as prices started to descend, hit the trailing stop. I've been out of this one for, I don't know, it might be a year or so now, and it's just continued to unwind. Is it in the process of turning around now, though? Possibly, but it's a little bit early for me at the moment. So it's made itself back above the moving averages. I'd like to see it just hold on to these gains. If it can just track sideways, maybe for a little bit, as these moving averages start to turn, and then probably for me it'd be a case of buying a breakout, then like buying a move up above these recent highs. So it's a tradable structure starting to develop. I don't think it's quite there yet, because of course what I've just sketched in may not even occur. It could then start to lose ground again. So I'd be inclined just to wait and watch at the moment. But yeah, you never know. There could be a change of trend coming. So that's where, like, you might have a watch list of stocks which you think these stocks offer potential, but I'm not quite ready for them yet. And some of them you'd be happy you didn't get into. You were patient and you waited, and others will ultimately give signals, and you can jump on board and see where they go. For this one here, yeah, I think a little bit more patience and watching.
Okay, let's get on to TAH.
Yeah, we've got the makings of a possible uptrend, but it is a bit on the messier side. I guess a lot of that is due to that fall in April, which was market related. Prior to that, it had been staying to move up nicely. I think if I had this, I'd be happy holding it. If I like what they're doing, I guess I could also consider buying it at current levels, because you're buying a stock which has rallied. It's now consolidated while the moving averages catch up. So kind of like, it's sort of like, it's not really what you'd call much of a dip at the moment. You're buying a consolidation potentially, which could then continue higher. So yeah, it's a stock which would certainly justify a position in a portfolio.
Bit of useless trivia for everyone, but Tabcorp was my first corporate role whilst I was still at uni, believe it or not, somewhere else. So Not that that's going to influence you in purchasing that share right now, but that was back in 2000. So I was wondering what was it trading at back in early 2000s, Jace? Can we go back that far or
Yeah,
what?
we jumped to a
Well, I'm
weekly
pretty sure
chart.
it listed back then as well.
Early 2000s. You were there for the boom, and then if you were there much longer, you were there for the GFC bust. And yeah, it's never regained those highs. So it's again, buy and hold. It depends what you're holding. If you bought in 2007, you're sitting at a 50% loss thereabouts. So of course there's dividends along the way, which takes out some of that. But from a capital perspective, it hasn't been having an exit strategy and being able to move the capital into something else. I think would have. I think that's why it's such a strong strategy, being prepared to get up and move when something stops working, because something can stop working for a long time and may never like regain its previous highs. So it's I'm not an advocate of buy and hold. ETFs maybe, individual stocks. Too many things can change, so you got to be aware of them.
All right, let's get on to PDN.
Was that T?
P for Paul. DN.
Oh, Paladin. So uranium's having a bit of a revival at the moment. So Paladin's probably been the one of the slower movers of the main local listings. Those being Boss and Deep Yellow and Bannerman. I think the others have had stronger structures, but nonetheless, it's rallied to the moving averages. It's consolidated now. It's popped above them. The averages are turning. Look, if I had this, I'd be happy to continue holding it. If I didn't have it, I'd probably just watch at the moment, see if we see if some consolidation develops, and maybe we get some sideways, and then from there we could pop higher again. And it would be the consolidation, then the pop high. That's where I'd be interested in maybe getting a position there. But again, as I said, if I had a position, I'd be happy holding that, and see whether this upswing we're getting in uranium, see whether it follows through and becomes something bigger. It may not. It may not be ready yet, but I'm happy. I've got some uranium exposure myself, so I'm happy to give it the benefit of the doubt and see if it runs. If it runs, great. If it doesn't, well, I can pull that back and wait some more and then have another go later on. But I think it's well worth a look at now.
Okay, fantastic. Our first ETF then, let's have a look at Asia.
Yeah, that's trending nicely. I'd be happy. I'd be happy in this, and I could be considered as a buy at current levels. It's just starting to clear the high from February. It just recently had a sideways consolidation. I like it when we get these sideways consolidations where you get a rally, the sideways consolidation holds on to most of that previous gain, and then it's also like a tight compression. They often resolve to the upside because they often indicate that there's interest in buying of the dip, buying of the pullback, and then as all the stocks absorb that's coming onto the market, you get that push higher, which we're seeing now. So yeah, look, I'd be happy holding this, and I'd consider buying at current levels. Have a stop back below the 100-day moving average, perhaps.
Mm-hmm. Okay, fantastic, good one. Next one, I think it's an ETF as well. WiMAX. An ETF.
Which one's that?
WiMAX. YMAX. Yep.
Oh, so it's a yield ETF. So this is really all about the. So it's probably like it'd be bond related. It's not really got much capital movement, but then it's going to be paying that yield. So it's interesting when you click on the adjust button, it adjusts for dividends. That puts the dividends back in, and you can see this has been from the COVID lows. It's just been a steady dividend payer. It's a sort of ETF. You could sit in longer term, collect the dividends. But look, I don't know a lot about it. If there certainly doesn't seem to be any issue hanging on and collecting the dividends with that. But just looking at this chart without dividends, there's nothing really there to talk about. There's no particular trend over the last couple of years. It's really all been about the income it produces.
Okay. All right. Let's have a look at WA1, please.
Yeah, I think this is interesting. So it's had that, big rally. Big rallies lead to big consolidations, and it's had that over the last year or so. Now what we find is gone from below the averages to above. Averages turning. We've got the sideways consolidation. What that consolidates that initial rally from below the moving averages. And it looks different to previous times where it's gone from below the moving averages to above. Because you look at all these previous times, and it really hasn't held onto its gains. It's rallied, then it's come straight back down. This is the longest it's consistently held above its 50-day moving average, probably since back when it was in bullish times. So starting to edge towards the new recovery high at the moment. I think it's the sort of stock which I think it could be bought at current levels, and then a stop loss could be, it could give it maybe like 17, 18%, like below the 100-day moving average and some. So you're giving it a reasonable amount of room to move. Like an aggressive play would be just having a stop below the low from yesterday. But it's still entirely possible that this hasn't finished going sideways, and we see more sideways consolidation before a larger lift off. There's nothing to say this sort of structure can't develop. So that's why I wouldn't have such an aggressive stop just below yesterday's low. I'd give it more room to move. So, buying it now by all means worth considering, but be prepared because it could still have more in the consolidation. But yeah, I think it's a stock with great upside potential, particularly relative to the risks. So worth considering.
Okay, we've got PNR from Jack G.
Uptrend remains in place. We've got to pull back to the averages. If I had this, I'd continue holding it. There's no reason to sell it at this point. It's like to stay on these trends. You've got to give them room to move. You can't stay in a gold stock if you're jumping out every time it comes back, 10, 20%. But I wouldn't be too quick to buy it at the moment. I'd rather just watch the consolidation for a little bit more, see if it starts finding support, a bit of sideways price action, then maybe getting into it a little bit later if we get the right sort of price action. But certainly one to hold for me. It's if I had it, I'd be holding it because the dominant trend remains the upside.
Okay. The next one is MAU.
Yeah, had a nice breakout a couple of months back. You can see we had that consolidation along the averages, broke higher, went for a bit of a run. It's given all that gain back, and it's now trading back below the breakout point. So that's disappointing. It would have been good to have seen it hold its ground while the moving averages catch up, and then you kind of get this sequence where it kind of like it's ratcheting higher. But that hasn't happened. It's come back. It's if I had it, I'd still be holding it. I wouldn't be selling it just on the basis of that. But it's not a dip I'd want to be buying at the moment. I want to see it get a foothold and start trading sideways, build that next platform to start rising again. It's one I'd be happy holding with a wide trailing stop, and I think it's in the motion trader portfolio, so there'll be a calculated trailing stop for it. But yeah, it's not a buy for me at the moment unless we see getting a foothold around that 100-day moving average, and then starting to rally off it.
Okay, let's have a look at C79.
Not yet for me, but it's getting close. It's interesting. It's gone from below to above the averages, moving sideways along the averages, and the averages have crossed. It's pretty close for me. I'd be looking just for a breakout above these recent highs. So say a print at 541 thereabouts, I'd say, okay, that's a breakout, and then I could then have a stop, say about 17, 18% below, and see where it goes. And it's certainly got upside potential because it's one of those stocks which could run. Could it double? It could double. So 17 to 18% of possible risk it's an asymmetric risk return setup. So it doesn't mean you're going to get the big upside, but it's certainly a possibility, and the risk wagered for that possibility is more than acceptable in my eyes. So yeah, I'd give it a little bit longer and buy the breakout rather than preempting it, because it could also just start to fade away as well. But at the moment, it's looking encouraging. If I'd bought some early, I'd certainly be holding it. But yeah, otherwise, I'd be waiting for a breakout.
All right, next one's WTC.
Yeah, look, it's starting to recover. It's below to above the averages. The averages are turned higher, close to crossing, and we're getting that sideways movement above the averages. It's not. Look, you wouldn't say this stock is in an upward trend at the moment. This is a big pullback. That kind of severs the uptrend. It's now got to reestablish into a trend. If I was holding it, I'd continue holding it. I'm just wondering, would I want to, I wouldn't buy it. I probably wouldn't buy it at this point, although I generally like the structure where you go from below to above the averages, and then you get that sideways movement across it, and it looks like it's wanting to push higher off the moving averages now. So for someone who likes this stock, it probably could be. I think it's probably could be considered as a buy at current levels with a stop back down, comfortably below the moving averages. There's certainly the prospect for upside here, I think.
All right, next one is another ETF. I think it's a DRGN from Neil.
Yeah, can't do much on this one. There's not enough price action, so it's only a new listing. So there's no trends as such to talk about. Yeah, always interesting to look at ETFs, but unfortunately, I probably need at least a year's worth of price data, at least 6 months, 6 to 9 months at the bare minimum. Otherwise, there's just nothing there for me to assess.
All right, let's get on to OBM from James, please.
Yeah, I've got some of this one myself. So it's still above my wide trailing stop, so I'm happy holding it. The extent of the latest pullback is it's notable and worth monitoring, because the gold price, we're not seeing this sort of pullback in the gold price at this point. So it broke to a new all-time high and then quickly gave that gain away. I think it really needs to quickly now find its footing and get itself back above the moving averages. What I don't want to see is a situation where it now where it doesn't really bounce and it just travels sideways and the moving averages turn down, because then that also opens up the possibility of then a breakdown. So I'm not suggesting that's going to happen, but it's the sort of thing I start to become aware of once prices get below the moving averages, particularly when it's like quite a solid push towards that decline below the moving averages. I now want to see a solid rally. I don't want to see like a shallow bounce, which then opens the possibility of further weakness. So it's not alarm bells at the moment, but it's keep an eye on it. Know where your exit point is. Not a dip I want to buy, but it could well and truly still stabilise and turn higher. So it's just being aware that being aware that there is a pullback of note to monitor and know where your exit points are.
Yeah. All right, the next one's IMB.
We don't really have much here. It's like it looked like it might have been trying to. We've looked at a couple of stocks like this today already, where you've got this sort of price structure below the averages to above, and we're getting the consolidation. I'm saying, look, I'd like to wait for a breakout and go with that rather than preempt it. And this one gave us a breakout, so I would have been looking at this and saying, look, okay, we've got a breakout, let's run with it, see where it goes. Have a trailing stop below the moving averages, and then this one it didn't go. It then it's come back. So you get these false breaks where it looks like it could be getting going and doesn't follow through. So this is why we spread risk. It's not all bets on one stock, because you can have a great setup and you get the early signs that it's all starting to come together, and then it fails. And it's not that the process of looking for the setup was wrong. It's just that not every stock will run. So this is a stock where, had I bought the breakout, I'd now be out. Okay, hasn't worked. Take a small loss and let's move on to the next one. And you just keep playing the game until you get one which breaks and then continues to run. And that's where the money's made. So this is for me now a risk containment situation. I'd probably be closing it out. That said, if from the way I do the motion trader exits, I have a wider initial stop, which helps reduce turnover, so it's not as aggressive. There's a case for holding it still, because it's still above these previous low points, and it could start to find some support above there and just start trading sideways for a period before having another push higher later on. But I think for the near term, the upside potential is now off the table, and it's now more a case of can it now find support back within a range before maybe having another upside move later on. But failing that, there's an exit stop I'd have an exit point for everything, and it's if it continues to weaken, there'll come a time where it's like, okay, it's had enough time, it needs to go.
Yeah. All right. The next one is, it's BTC. So that's the crypto's looking like today.
So momentum's to the upside. Do we have a zigzag correction? Certainly could. That meets the criteria for a zigzag correction. I had thought that it was more. I thought that maybe this was going to be more of a coiling type situation. We're going to see it just move sideways and then maybe have a push higher, but it didn't do that sideways coiling along the averages, because just a couple of days ago it had this break lower below the June low. So hence you get now got the zigzag. I think it's important that it holds the low from this week. If it breaks the low from this week, then you start getting a series of lower lows, which starts to take the near term upside potential, or starts to disengage that underlying momentum we've had from the April low, and then sets up more of a case of like, is there going to be like is it a case of a larger sideways pattern in the making, which could take months to resolve? So I'm in Bitcoin. I'm still giving it the benefit of the doubt. Let's see whether this is the zigzag before higher levels. But yeah, if the recent low goes, well, then I'll start looking at, like, is it time to close this out? And because maybe it moves into a larger consolidation, might not be the time at the moment. So benefit of the doubt for now, but just be aware, things change, and be prepared to shift when the price action says yes to.
Okay, EOS from Yuki.
Well, if I was in this, I'd continue being in it, I certainly wouldn't buy it here. It's so stretched above the moving averages. Yeah, it's a case of, for me, if I bought this at good levels, I'd just be holding, see what this see what this pullback looks like. Is it going to be a pullback which finds support, or does it just come all the way back down? But it's a case of, like, give the upside the benefit of the doubt and have an exit point below the 100-day moving average. That's the way I'd play this. I wouldn't be looking to buy it at this point. I'd want to see the consolidation play out for a bit more. Start seeing the dip being bought, and then consider entry points. But for now, for me, it'd be, let profits run. We're going to get these. You're going to get times where you get these big gains, and where it requires a bit of courage to sit through the pullback, to have the potential of staying on what could be a larger trend. It's I know these pullbacks can be unnerving, and some of them do come all the way back. But this is, it's just how the stock market plays out. It's if we want the potential of much larger gains, we've got to be able to sit through the pullbacks that come after big rallies. Otherwise, you're always getting out. So for me, it'd be hold with a wide trailing stop.
Okay, the next one is DUR.
Starting to get a sequence of lower lows, and moving averages have turned down. I'd want to know where my exit point with this was, and I'd be using. I'd want to know where my stop loss is, and be prepared to close this one out if it deteriorates much further. It really needs to now, like lock in and get a foothold and start pushing up. Otherwise, it does open the risk that there is a further decline. It's sometimes, like, we've had good momentum over the through till around April, through to about March, but it's just been giving way over the last few months. Maybe this one's not going to continue. Maybe it's not going to be like the trend from 2022, 2023. I'd want to just firm up where my exit point is in this, and I certainly wouldn't be buying it. I wouldn't be buying a sequence of lower lows below the moving averages, hoping for a rally. It's more a case of now managing where I might need to get out, rather than thinking about getting in at this point.
Okay, let's have a look at TLX. Morris, if you're listening to me, if you can hear me, I'm trying to find your stocks. He's saying we missed it, but if you could just pop them down right down the bottom there again, and I'll scroll down and have a look, because I can't find them. Thanks, Morris.
Well, TLX, what worries me a bit here is that it's been, like, just holding below these moving averages for a few weeks now, and the average is now turning to the downside, and it's also starting to break below these lows from recent weeks as well. So it's starting to develop a bit of downward momentum. If I had this one myself, I'd still be holding it. Like, where, I'm just thinking, like, so this would be a motion trader stock. An entry point would have been where the averages cross and it makes a new high. So how much was that up? Yeah, so it's not at the point where I would have scaled out. I tend to scale out sometimes when a stock's up maybe 200 or 300 or 400%. This one's been up about 179%, so it's not really where I'd be scaling out. So if I had this, I'd be holding my full position and I'd know where my calculated trailing stop is, and that's what I'd be doing. I wouldn't be buying it at this point. It could still it's starting to develop it's starting to move into a window of vulnerability, but that doesn't mean it's going to fall away. It could remain vulnerable and continue to weaken a bit, but then turn higher. But that's what the wide trailing stop's about: is giving it that room to see how the price action is going to play out. It's just because I wouldn't be buying it doesn't mean I'd be selling it. If I was selling every stock every time they went through a period of vulnerability, I'd be getting out of my best stocks way too early. So I've got to give it a chance, and that's what the wide trailing stop does. But yeah, it's certainly not a buy. It's a hold for me with just firming up where my exit point is in case it continues to weaken.
Okay, the next one along would be DRO. How would you deal with DRO, the volatility of DRO? What target would you set to take profit? Obviously, a bit harder to answer, but yeah.
I wouldn't be using a take profit target. It'd be like in all my experience and all the back testing I've done, the biggest profit making situations occur when you leave gains uncapped. It's when you start having profit targets that you limit your upside, because you're taking your best players off the field when they're running hard. Now that doesn't mean you can't scale out, but I always want to leave some portion running when it's running. It invariably means I get out below the high, unless the stock's taken over, of course. But that's okay. That's how I can get stocks that go 200, 300, 400, 500%, because I don't cap those gains. A lot of people, they want to, they're always wanting to go, oh, like when should I lock it? It's 100%. Should I sell now? 150. Should I sell now? And if you're doing that, that's great. They're terrific gains, but you're probably never going to get the outlier because you won't hang on long enough. So I wouldn't be capping my gains. If I was up several 100%, a couple of 100% or more, I might think about scaling out, but I'd still keep a good balance. With this at the moment, I'd be holding. If I had this stock, I'd be holding it. It's the moving averages are trending higher, the price is trending higher. Yeah, it's pulled back today, but so what? It's become stretched above the 50-day moving average. It needs to pause and pull back to make it sustainable, or otherwise you end up with a blow-off top situation like we've seen previously. Like these other pullbacks, these are notable pullbacks to the moving averages, but if you give them room, often you find they stabilise and they can push higher again. So I'd be in, I'd be holding it. Wide trailing stop back below the 100-day moving average, see where it goes, but I'm probably not a buyer at this point. I'd like to see how the next consolidation looks.
Okay, next one along is Dash, D-A-S-H. D-A-S-H.
Is that it? D-A-S-H?
Yes, S-H.
NASDAQ, DoorDash.
Yeah, I believe so.
Trends up. I'd be staying with it. Yeah, it's this is why we have wide trailing stops, see off periods of volatility. Stocks can dip below their 100-day moving average, and that's why I'm often talking about having stocks below the 100-day moving average, not using the 100-day moving average as the stop. So giving a bit more room. But I think this was how big was that? 27%, depending on how the calculation for the trailing stop worked. That was probably a survivable pullback if the trailing stop was based on average multiple of the average trading ranges. Look, I'd be holding it, let it run. It could possibly be bought. It's making new highs, so making new highs isn't a sign of weakness. It's a sign of strength. So I guess it could be considered as a buy at current levels with a stop back below the moving averages, because it is kind of breaking out of. You kind of could call that a period of. Well, you could. It is a period of consolidation, and it's now starting to lift out of it. So it could even be bought at current levels. Interesting stock.
Okay, the next one is HOWM. These are all US stocks, I'm assuming.
Trends up. I'd be sticking with it. It's been a great trend too. Terrific trend. The power of trend following. And this, we talked about this. Why I'm not capping upside. Like, who knows how far a trend can run or how long it can last. So don't tamper with something that's working. Let it keep working for as long as possible and give it room to move, so you can hopefully see off these pullbacks that you invariably get along the way.
Okay. RDDT.
Yeah, I'd just watch this one at the moment. It's too early for me. It really came apart in April. It's found its way back above the moving averages, but it's just too early. It now needs to consolidate above the moving averages, let the averages have time to cross. And it's a case for me that I'd be looking to buy maybe a breakout from the next. So say we get the sideways consolidation, it's the breakout. It's the breakout from that consolidation I'd be looking for. If we end up with that sideways, I'd consider buying the breakout. It's too early. I don't know. We don't know what this is going to look like, or is it going to be like? Is it like a pokes its head back up, and then it makes its way down again? We don't know. So I'd just leave it for now and watch it, and see whether we get a good setup developing. Maybe we do. Time will tell.
Okay. Caroline. Hey, Caroline. Let's have a look at AVH, please.
Unfortunately, downtrend here. Not one. I wouldn't be in it, and I wouldn't be looking at buying it. It's this is why I think it's so important to have exit strategies, so you don't get caught in this situation where it's like it just keeps falling away, and you wonder, what should I do? Should I hold it? Should I sell it? People worry, if I sell it now, it'll probably bounce back, and maybe it does. But the question I pose to people is, well, okay, it may bounce. If you sell it now, it may bounce back. But what if it falls further? What if it goes from $1.50 and it's down at $1? Then what do we do? And if it goes from $1 to 50 cents, then what do we do? It's like you got to look at it's a what if. It's like, what if it bounces? What if it doesn't? That's the problem. So probably best to try and have strategies to not be in this position in the first place. But it's tough. It's tough when you do find yourself in this position. Like, what do you do? It's and of course I can't tell anyone what to do, but it's why I say, that don't turn your back on individual stocks and have a plan to get out of things aren't working. I think that's the best we can do. And these to help doesn't really help us if we're in this situation, but to help us not get into these situations going forward.
Okay, and the next one to have a look at here is, let's go have a look at NGI, please.
I'd just be leaving this one at the moment. How big was that pullback? I think the pullback was big enough to take out a wide trailing stop. I'd just be on the sidelines with this one. If I was in at good levels and I did see off this pullback, well, sure, maybe I could stay in there and give it a little bit longer. I'd probably need a line in the sand somewhere. That would probably be my line using those previous lows. So if it were to turn and if it was to turn and there we go. I think I've got it this time. Turn and break lower again. I'd say, look, enough's enough. I'm out. But if that doesn't happen and it stabilizes here and pushes higher, well, great. So if I'm not in this one, I'm not getting in at the moment. I need to see it start to break higher to consider an entry. If I was in it, that's how I'd be probably looking at it.
Okay. Next one's SIG, SIG, I think.
It'd be Sigma.
Yep. Claudette, thank you.
The long upward trend continues. So for me, it's a hold. See where it goes. It does look like it is losing a bit of its momentum. Like, you look at the momentum from earlier times, it's like these strong advances, and you look at the rallies now, it's overlapping. So it rallies and pulls back, rallies and pulls back below the previous peak, rally, then pulls back below the previous peak. So you got all these overlapping moves. So that could be a sign of the trend losing strength. It's probably not the stock I'd be looking to buy now. If I had it, I'd give it the benefit of the doubt, but I'd know where my trailing stop is. Should it start to break down? But it's not breaking down at the moment. It's just something I observed that the rally is overlapping. So unless it really accelerates again, it could be a sign that maybe it's getting a bit tired. But look, still, there's no problem for me hanging on to a stock like this and just knowing where my exit is.
Okay, VHY. We're comparing this to YMAX. It's another yield.
Yeah, this one's got more of a general upward trend to it. Let's just adjust those dividends back in. Yeah, and it's been a good income performer with some capital growth as well. So it's probably been the pick of it's been the pick of the two. Yeah, look, if I was holding this and this was my thing, there's no problem with continuing to hold that. It's but ETFs yield. It's like it's not the sort of thing I'd probably have a trailing stop on. It's it's this again, like ETFs can be different to individual stocks. For what you're looking for from them. That one looks no problem. I'd have no problem continuing to hold it.
All right, QPM from Jesse.
Yeah, no, it's below these moving averages. It's had a look like maybe something was going on. We talk about stocks like this. We get stocks like this. We see from time to time these low price stocks where you start getting building blocks, and it's like, well, what do you do with this? Do you go, well, look, I've quickly doubled my money. Should I just get out, or should I let it run and see if something bigger develops? And I'll typically say, look, I'll let it run, but be aware that these small stocks, they can run and they can come back, and this one's done that. Has come back. So it's like and then I guess you consider, like, what is it that I'm playing for? Am I playing for the quick double move, or am I in there trying to get the lottery ticket where it goes from 2 cents to $2? Everyone's going to have their own take on what they're after. With this one now, it's a case of, well, I'd be out of it if I was playing that upward move. I would have been out of it probably in May when it got back down below the moving averages and lost that momentum. And as for where it is now, the momentum's now shifted to the downside. So it's like 3.5 cents. People say, well, how much further can it fall? Well, it can fall 100% from here, I guess. I'd be managing I'd be very aware of what my risk parameters around this stock are.
Okay, LOT.
Maybe a basis forming a little bit early. Maybe it's starting to try and turn higher, but it's just I just need to give it a little bit more time. It could also have moved into the moving averages, and then it could still turn lower again. There does seem to be some general uplift across some of these resource stocks generally, so maybe something's developing. But look, I'd probably rather see it do a bit more sideways and then buy a breakout. We don't really have a breakout yet. We've got what could be a slowly turning basing type looking structure. Like for instance, if we got, I draw the same sort of sequence every time because that's what I look for. If we get that sideways and then we get the breakout, that's where I'd be considering getting in because the moving averages are also starting to turn with it. So I'm going with the averages and I'm going with the price. At the moment, we're just sort of hoping that that something's going to develop, but it could just as easily find itself doing that. There's nothing to say this can't happen. So I'd be inclined to give it a little bit longer and just see if we get a clearer picture for some clearer parameters to play with.
Okay, thank you, Maurice. We've got QOR, please, on the ASX.
Yeah, look, it's I'd probably go with this. It's rally back to the averages, consolidate, rallying again. It's at current. It's probably like this could be a buy at current levels with a stop, 16% stop thereabouts. See where it goes. See whether it can get some momentum up. Plenty of stocks which start to show signs of momentum don't go on with it. This could also like peter out around the previous highs and come back and do more work, but it could also run as well. So I go with momentum. I give it the benefit of the doubt. I see if it keeps going. If it does, great, hold on. If it doesn't, rotate into the next idea. Don't lose too much. But yeah, at the moment, I'd be happy holding this. I'd consider buying it.
Okay. QXO on the New York Stock Exchange.
Yeah, it's got some. It's an impulsive rally, rallies. There's that sideways consolidation above the moving averages. Rally again, consolidate. If I was holding some of this, I'd keep holding it. See what's going to happen. I probably wouldn't buy it at this point because is probably a bit stretched above the moving averages. Look for the next consolidation. See what that looks like. Don't know what the story back here is, but. Yeah. Look, I think probably one to, as we've been talking about, let it run. It's working. Know where your exit point is. For me, it'd probably be back below these previous lows from June, below the 100-day moving average. Or wait for the next consolidation, see what it looks like.
Okay, 1571.
Yeah, it's starting to lift off the moving averages. It's I've got a few like this today where they've rallied, gotten back to the averages sideways, starting to break higher. I could go with this one. Have a stop back down here, probably below the May lows as an initial stop. I tried if I can run a tighter initial stop on a discretionary basis, that's all good. But then if it does start running, I'd widen my stop, a wide trailing stop. I think is indispensable for what I do, looking for like medium term gains, 1 to 3 years. But yeah, this is one I could look at. Interesting.
All right. EL8 is the last one for today. We'll look at
EL8. So I've got some of this myself. I got some the other day. I think I got some on Friday, just as prices pulled back. So we've gone from below the averages to above. We've got the sideways consolidation, and we've got a secondary rally off the averages. So I bought that pullback. It's this whole uranium space has the potential to turn into something at the moment, but it's like will it or won't it? We don't know. So we never know. So it's a case of I think the risk reward is good. So I can have my stop below the low from below the June low. So if it gets back below the June low, I'll just close out and go fine. Lose what would it be? Drop about 25% or something. But if it rallies, it could easily go 80 to 100% or more. So it stacks up from a risk reward basis. I'm happy in there at the moment. I think it could be bought at current levels, or alternatively, watch it for the near term and see whether we get another sideways motion and then buy the breakout. So a couple of ways to play that. Current level, it could be justified as a buy, or you wait for more consolidation, buy the breakout, and stop as it remains below the this June low. So it's going to be interesting to see what happens with uranium, whether this does develop into something or not. So we'll keep checking in on it.
Beautiful. All right. I think we are done for today, Jace. There's probably a couple of general questions in there which we might push to next week at this point, just around corporate actions and selling around tax time. So let's revisit them next week. Thanks everyone for coming along and providing us all your questions and tickers. It's much appreciated as always. We wouldn't have this show without you guys coming here and providing us these tickers, and we really enjoy, as well as looking at your tickers, having ideas that everyone else can share amongst the community is really helpful for everyone in this community here on YouTube, right? So I think it's a great benefit of this show, and it wouldn't be here without Jason, obviously. So thank you, Jason, for your efforts as usual. Jace, thanks a lot.
Roger, that's been fun. Hopefully it's been interesting for all our viewers, and it's been fun going through all the stock codes. Always see a few new stocks each week, and look forward to next week's show.
Great. Don't forget to like and subscribe on the show. Send us your comments. If you've got any questions for next week, put the comment in the show, or send an email through. You can check out Jason over at motiontrader.com.au. And obviously, if you're not a Selfwealth by Saif client, you can check us out at selfwealth.com.au as well. Thanks, everyone, and have a great week. Stay safe out there, and we'll see you next week. Take care. Bye-bye.